covered call strategy, the seller of the option is essentially selling the future potential upside or volatility in a stock they own, in exchange for payment from the option buyer, also known as the call premium. Covered call writing is a strategy that, when implemented effectively, can help investors enhance their portfolio's risk-adjusted returns. With a covered call strategy, an investor owns an underlying stock and writes a call option against that stock. By writing or selling the call, an investor agrees to sell the underlying stock at a predetermined price sometime in the future, called the strike price. In exchange, an investor receives a payment from the option buyer for writing the call. So how can this strategy lead to great risk-adjusted returns over time? Our research shows that investors have persistently anticipated higher volatility in the market than what has actually been realized in the future. By overestimating volatility, many investors overpay for the potential protection of owning an option against that future volatility. By selling options, the seller can attempt to profit from the buyer's overestimation of future volatility in a stock, essentially their fear of missing out on future upside. When an investor sells these calls against stocks that they own, they sell future volatility and receive payment in the form of call premiums. Those premiums introduce a new source of yield into a portfolio that can complement dividends from underlying stocks and interest from fixed income holdings. Our research shows that investors have earned the highest risk-adjusted returns by writing calls against low volatility stocks. While this may result in collecting a lower initial premium, low volatility stocks have had much lower downside risk relative to high volatility stocks, and thus over time have earned much higher risk-adjusted returns. Overall, we believe introducing a covered call strategy to a traditional portfolio of stocks and bonds can diversify portfolio yield and enhance risk-adjusted returns.
T. Rowe Price.